Hey guys, welcome back. So this video is on something called expectational order flow, and the basic idea of it is if a market is trending, we have certain expectations. And the reason it's important to understand these expectations is it kind of lets you have a trade plan and it helps you build a narrative, and you need to understand what market cycle you're currently in. So we have the trending phase and we have what's called a pullback phase. So in this video, we're going to talk about expectational order flow on the 4-hour and the 15-minute combined, as these will be your main analysis timeframes. Just so you know, expectational order flow works on monthly, weekly, daily, whatever time frame you want to use it. But in our course, what I teach is the 4-hour and the 15-minute. It is a great time frame to get you on the right side of things. If you're day trading, it can also be a great thing to do your analysis on if you're swing trading. Now, if you're into the swing trading side of things, you'll likely add daily and weekly analysis to that as well. But right now we're talking about day trading, and we're going to talk about expectational order flow. So what we're going to do here is we'll make this line black. The black line is going to represent a 4-hour bullish trend. And the expectational order flow works in either direction. And the core concept of the expectational order flow is that continuations will work 7 out of 10 times or 8 out of 10 times. So let's even say 4 out of 5 times they'll work 80% of the time. Reversals only work 20% of the time. And it's important that you program this into your head so that you're not trying to think you've caught the top or bottom of every reversal, because that's not what we're actually about. We're about analyzing the market and taking higher probability setups. And one of the tools we have in our arsenal is expectational order flow. And I'm going to describe it in a little more detail. But just before we get going, I'm going to change this to a blue, and we'll go a little smaller. So the blue will represent 15-minute. Just before we start on that, I want to talk a little bit about this. So as the market's making higher highs, higher lows, higher highs, at this point the trend is confirmed bullish. So my expectation is once we took this high, there is going to be some sort of a pullback. So if we put in a higher high and the trend is now confirmed, the expectation is there will be some sort of a pullback. And every time that there is a new high, there is going to be some sort of a pullback. Now it's important you have this scenario mapped in your head, because this happens over and over and over. So the idea is that we want to be in as many continuations as possible. And you're probably saying to yourself right now, well, what about all the pullback trades? I'm going to miss out on all those pips. Well, no, you're not. You're going to catch those continuations on a smaller time frame, the 15, and we'll get into that. So this is the 4-hour time frame. Higher high, higher low, higher high. When this higher high printed and we took this high, my expectation is we're going to get some sort of a pullback. More often than not, it'll come to a relative equilibrium pricing. Not always, but most of the time it will. Now, as we put in another higher high, my expectation is once again to have a pullback. And we will talk about how to spot changes of characters a little earlier as we get into that section, but I just want you to focus on expectation order flow for now. And the idea of this is that if we're trending bullish, the 15-minute is currently with the 4-hour time frame. Now here, the trend starts changing on us. However, on the 15-minute, the trend starts changing on us. However, this trend hasn't fully changed till we took this low. Like right here, we just took the low. So 15 is now unconfirmed bearish. So now you could start formulating ideas of shorting this. And as price retraces back to whatever caused the flip zone up here, and we'll get to all that, but as price retraces back to that, you can now start building narratives of shorting. And more often than not, you can short to roughly 50% of the 4-hour leg, or relative equilibrium. Now, as we get to 50% or more, shorts become lower probability. And my expectation is that the 15 trend will likely end and the 4-hour trend will likely continue. So now as we take this high on the 15, we now just became bullish. Unconfirmed, but bullish. We're in line with 4-hour trend now. And now we can start making trade ideas to continue with higher time frame narrative. Now, as this high gets taken, you'll definitely want to take some profits because we never know how high it's going before the retracement. But at some point, the 15 trend is going to end and it's going to pull back. And now we have a bearish continuation on the 15 minute. Now keep in mind, sometimes the pullbacks last for days, so that's still a lot of pips to catch even though you're counter trend. And as long as the 15 is only showing signs of bearishness and we're still in that premium side of pricing, we can continue shorting. So now the pullback ends and expectational order flow kicks back in and puts us back in line with the 4-hour time frame. Now there's going to be a lot more pips to be caught to the upside than the downside. That's because the higher time frame is bullish. So the idea is to have longer trades with trend and shorter trades counter trend. But you can play both sides of it. So now we printed a new high and we now see an expectation of a pullback. Now if you're wondering why the 15 minute is higher than the 4-hour, this is likely just 15 minute wicks. A lot of times it'll wick higher than the 4-hour body's print. So that's why. Now again, 15 minute turns bearish and we can play that bearish pullback. And at some point this pullback is likely to end. More often than not, relative equilibrium, but that's not guaranteed. So as the bullish trend resumes, we can now formulate trade plans of holding longer trades. And every time you take a 4-hour high, you're going to want to pay yourself because a lot of liquidity lies up here, and we'll get to that in the liquidity section. But anytime a heavy amount of liquidity is taken, there is a pullback coming. We're not guaranteed it's right away, and we don't know when. But now we can have an expectation that there will be some sort of a pullback, and this is going to continue on till the 4-hour trend wants to change and go the other direction. Now, something I want to make note of is how many continuations there are. One continuation. Oh, hold on. Let's actually, we're going to change that to let's go orange. But let's make note of how many continuations there are. So you have one continuation here, pro 4-hour trend. One continuation here, counter 4-hour trend. Continuation, continuation. And look at all the pips there is to catch in the continuations of these legs. So what the idea of expectational order flow is to follow current order flow till it no longer works. Now if we look at the amount of reversal points the market has compared to the continuations, there's less of them, but the chance of you catching the very bottom or the very top is a lot slimmer than just going with order flow. So rather than trying to catch a falling knife or guess where the reversal is going to happen, because we never know, we wait for a trend to form and we follow that trend. Now, as soon as a 4-hour trend goes to do the pullback, we don't consider the trend actually starting the pullback till a change of character happens. And what a change of character is you took this high with this point, and you now took this low that put in the high. What that's signaling to me is there could be a change of trend, also known as a change of character. And more often than not, what you're going to have is a supply zone that caused the change of character. And you'll look to form short trades off that. And change of character happens on every time frame, but it's our first clue that the trend is changing. And we want to see this on the 15-minute paired with the 4-hour. Now, as the trend comes down here, once again, we have the last low is taken here. So what this is considered liquidity in this case. And then the high is taken here. So now you've swept the lows and you've swept the highs. So another change of character just happened. The other way of looking at it is supply is in control the whole time you're coming down. The last point of control supply had was right here as it pushed price down one more time. As price comes right through supply here and a change of character happens, it's our first clue that supply lost control. And as supply loses control, demand takes over. And we now want to formulate trade ideas the other direction, especially when it's with 4-hour order flow. Now, let's just show this concept on the charts. So here we have Euro USD, and you'll see me use this a lot as it's one of the easiest pairs to trade. Let's see, where's a good area? It pretty much happens in any area on any time frame. It doesn't matter which one you pick, but the idea is, we're gonna just delete this or even move it down for now. But the idea is, if you're looking at this and we're just mapping structure right now, the first time a high is really taken is somewhere in here. It's not the greatest structure, but we're going to call it structure. And again, you can almost go to here. Like that could be, let's see, 203. 952, not quite enough. Like you could classify this as structure, but I'm going to go with this point because it's a little better. And the idea is that you are more likely to make more money following order flow. And order flow on the 4-hour is obviously very bullish right now. And here we turn bearish. And if you're wondering why you turned bearish, if you actually went on the daily, more than likely this is a daily pullback. But we're just going to focus on this time frame. So this is very similar to what we were doing on market structure, but I just want to show you it in action so you kind of have an idea of what to actually do with these time frames. So here you wipe this low, order flow changes. And if you actually look, you wipe these highs and you wipe these lows. So that's a 4-hour change of character. It's our first clue that order flow may be shifting to the downside. Now you put in a second low. This is now a confirmed bearish trend. Now if you look, I can't tell. I think that's... I'm going to move this tip over, but I think this is a point of market structure. Yes, it is. Okay. So we do take that low, and what we can see from this point is the bearish trend is likely to continue once the trend is established. Again, not the greatest structure point, but it's some sort of a structure. And ultimately we take the low. I think this is actually structure. I don't love it, but it's structure. And we won't map the whole thing. I think you guys have sat through enough structure mapping. I just want to kind of explain the concept of expectational order flow. Let's just double check this before we get going. So yeah, so this would be the first point where we broke structure. So now, the idea is as we're bullish, we want to just keep buying as much as possible. Because if you look at the impulses and the size of them, good impulse, little impulse, huge impulse, little impulse, kind of a bigger impulse, small impulse pullback, large impulse, small, large, smaller, larger. So you get the concept here that when we are pro-trend, and at this point you also have to remember that the daily would be bullish as well. So even though the 4-hour does turn bearish on you, it's just to grab these equal lows, mitigate the daily order block that's right there. And the idea was to just grab this liquidity and fuel the move to continue going up. And you can tell the momentum's still bullish by the size of this impulse. Huge impulse, small impulse, huge impulse. And the same thing happens on the flip side of things. As order flow changes here, you can start seeing the larger impulses are to the downside. If you check all the impulses out, the majority of the impulses are bigger to the downside than they are to the upside. And anytime order flow changes, so here where we become bullish, the impulses to the upside are larger. And you can tell this by the size of the candles and the amount of them. So look how big these bullish candles are. You can tell the impulse has a lot more pips to the upside. As order flow shifts here, the larger candles are to the downside. You can see how aggressive we're moving down versus how slow the pullbacks are. The slow pullbacks are the market stacking liquidity, so they can acquire more orders and keep grabbing liquidity to continue on down. But the momentum is to the downside. Every time we move down, big aggressive candles, slow candles back up, aggressive candles down, and you can ultimately tell that we're very, very bearish, very aggressive to the downside, and look how slow the pullbacks are. So now, just going back to where we were, we're just going to go on the 15-minute side of things. And this may get a little bit messy, but it's important people understand expectational order flow. Because a lot of your narratives are going to come from following trends. Now, we're not going to sit here and map structure. What we are going to do is understand that once a high is taken and order flow has shifted, we are now going to be looking for more buys. So as you get on the 5-minute and the 1-minute, there's going to be a lot more opportunities taking buys. And you can see this demand holds for quite a while. And the reason this demand holds is actually, we'll go over this in more detail later, but what we have here is basically a supply point. And you can see the interaction we have between the buyers and sellers. So this wick here is the initial reaction point, meaning price hit that, it retraced back, that caused a long wick. Now what took out the reaction point and actually completed the break of structure? We would say something in these two wicks. There's a popular saying, and it's basically there's always shit in wicks. And that's because the only people that have the kind of capital to move price away aggressively like that is the BFIs, banks and financial institutions. So every time there's a long wick, you'll likely see a V-shaped reaction on the smaller time frame where price aggressively moves away. And that can be an indication of price reversing, which is what we get here. But the idea is this whole time, as we are bullish, you are looking for buys. So here you took a buy, you aimed for here. Now, the next time price comes down here, you may take a buy again. You may not. But ultimately, what's going to happen is you're going to want to keep buying this up as the order flow is currently bullish. This is your low, this is your high. And as long as this low stays intact, we are going to continue buying. There's going to be more opportunities to the upside. With expectational order flow, one of my expectations is, so this is not a confirmed trend yet, so this would be your first high, pullback, second high, so you're confirmed bullish. Now here you take the low, but you're unconfirmed bearish. You never put in that second low to become confirmed. And what we're basically looking at is, at that point, you are still open to shorts and buys as the trend's not confirmed. And we'll get into this a little more in the liquidity section, but we may as well start kind of learning about it. The idea is that we're going to want to keep on buying. And every time we come to a demand zone, there's a reason why this demand failed. The reason is we stacked liquidity, we run liquidity. Liquidity's been run. My expectation at this point is, once we have a change of character, which happens right here, hold on. So we sweep the lows, we sweep the highs. So you are unconfirmed bearish at this point, and obviously you won't turn bullish again until you take this high, but we can start building a narrative that we're unconfirmed bearish and the 15 supply failed here. So we swept the lows, we swept the highs. If we go back to what we just did earlier, you have a supply zone, and ultimately you have a reaction point. Now, more often than not, they will come back and mitigate what took out the reaction point, and this happens on every time frame. 4 hour, daily, 15 minute, 1 minute, it doesn't matter. It really doesn't. Sometimes they'll come through this area and go for the extreme, and that's just the nature of the game. We can't predict it every time, but more often than not, they'll come mitigate what actually took out the reaction points. And what this is supplies in control here, supplies in control, demand starts taking control but doesn't fully take control till this supply fails. So at this point we can make an assumption that if this supply fails, we can maybe expect the next one to fail. Not necessarily confirmed till this high goes, but once this high goes and we are bullish, we can now start creating a trade idea that the trend is likely to continue up. So my expectation is, as this high is taken, is that we are going to continue on up. And at the same time, my expectation is this low will not get taken if this trend is to continue. Now, as we move on up, we know that at some point the 4 hour trend's got to end. And again, we take the lows, or we take the highs right here, and we take the lows. And in this case, you had a bit of a reaction point, depending which demand you look at, but you would say something in here reacted to it and this took it out. But in this case, they came up to the extreme. This was likely a news event. These long wicks are generally only caused by news. But the idea is that you took the highs and you took the lows. So now we can start building a narrative that this is likely to pull back. Now, we can never know for sure how far the pullback is going to be, but more often than not, if we are shorting, we can expect it to come to either equilibrium or relative equilibrium in between the blue lines. So if we are to start taking shorts, as we approach the middle of the zone, which is 50%, we're not going to want to keep shorting because we know the 4 hour trend is bullish and expectational order flow is likely to play out. So it's actually not what I wanted to do. Whoops. So let's just pull a simple trend line. So as we're shorting into here because of this change of character, once we get lower in the leg and we've tapped the equilibrium zone, we're not going to want to keep shorting thinking we're going to run this low. We are bullish and our expectation is for this low to stay intact. And yeah, it can come all the way down here and then up. We never know where, but the probabilities become lower on the pullback as you get lower in the leg. So now here, price impulsively moves back, and you may have not had an opportunity to catch that as it completely left, but you may have, had a 1 minute entry and just seen how aggressive it is and just taken the opportunity to jump in on that. But again, the expectation is that our pullback is complete when this high is taken. So you swept the lows, you swept the highs. If we actually look at this, so the high is actually not taken till this doji. So that's actually the cause of the high going. So you would actually find a trade in there, believe it or not, on the 1 minute or the 5 minutes. That would have been your entry somewhere in there. And your expectation would be that this is going to come higher. So the idea is with the 4 hour being bullish. Now this is just a larger time frame entry. You could probably get in quite a bit tighter on the 1 minute. But the expectation is for this trend to take this high. And at a bare minimum, you would pay yourself at this high. So that's an 11R right there. And you could take 50% or take 70% or whatever and let the rest ride. Because your expectation is that the trend is going to continue up. Now, as we go further on into this, we can start looking at new trade ideas. So the last demand level that sort of put in any sort of a high on the 15 would be this demand. A lot of times it will come down lower and something in here. In this particular case, this demand showed us multiple signs of it's going to hold. And what I mean by that is you swept the lows and you swept the highs. So you had a buy opportunity here, which you may or may not have made money on because you would have been aiming for this. So this is one of those cases where you might have broken even. But you might have even got in again. You swept the lows again. You swept the highs again. You might have got in again here. And whether you took partials at the top, which is probably a smart thing to do, or you just can't let price come back and take you out at break even, that's completely up to you. But we're going to get into that in the management section. But eventually, changes of characters work as there is to get in. You swept the lows one more time. You swept the highs one more time. And what happens here is you had another demand zone. So something in here on the 1 minute would have given you a trade. And your expectation is to put in a new high. Now, while you're in this amazing trade of yours somewhere in here, and don't worry, you'll get much better results as we get into entries on the 1 minute and the 5 minute, and I'll show you different entry styles. But the expectation is, even though this impulse is very bullish, that there is going to be some sort of a pullback. Now this one, you may or may not have even caught this pullback as it pulled back and pretty much went the other direction pretty quick. And let's just zoom in on that. We can kind of look at it a little bit closer. So if I just move this up a bit just so we can see, but again, you could see liquidity was taken. You didn't take these lows, but you did take these lows. And then these highs were taken. So in this particular case, they came back to the extreme. Now, we never know which zone they're going to come to or why. What we do know is it'll be either what took out the reaction point or most of the time the extreme. And those are the areas we like to work off of. But something in here on the 1 minute or the 5 minute would have likely got you an entry. Now my expectation is if we are to continue bullish, which we showed intentions of doing in this area as we disrespected supply, at a bare minimum this high should go. Now on the same side of things, oops, I didn't mean to do all that, but on the same side of things, as we take this high, we expect a pullback. So we don't know where the pullback is coming from, but we know that after we've taken this high, it may run however many pips or it may pull back right away. But nonetheless, the expectation is to have a 4-hour pullback. Now, on the 4-hour, this would be a very much larger demand zone. But my expectation is if the bullish trend is to continue, this is to stay intact. So when price gets down here to the extreme, we can start thinking about buy ideas with expectational order flow. And this continues on pretty much on every time frame, on any pair. And the idea is rather simple. We're just looking for clues from the market that the market is done going down. Well, where does that clue come from? Again, supply zone fails when this high goes. What caused it? Well, we could say something in here, and we did get a bit of a reaction from that demand zone. You may have formed a trade ID off that if something on the 1 minute showed you that, and you would have likely broken even on that trade. And we'll get into that with trade management. In this case, they came for the extreme. But again, the expectation is for this low to not get broken. So something in here would have chalked and flipped. And chalk is change of character. You'll hear me refer to it lots. So definitely get used to that term, chalk. But something in here on the 1 minute would have told us that it's okay to buy. And at this point, our expectation is to continue up. As price showed us here, its intention to continue up as demand once again took control. Now, as price takes this high, and we would have probably paid ourselves a bit here, second target would have been that, the 4-hour high. My expectation is that this demand zone will stay intact and that this low will not fail. There will be a point where expectational order flow does fail you, and there's nothing you can do about it. That's just the market. But this is where trade management is going to come in. But the idea remains the same. As long as 4-hour is bullish, we're going to expect an impulse to take this high. At some point, we're going to expect an impulse to pull back. Now, if we look at this price action, there's really nothing that's signifying a pullback till at least here. So you may have taken a loss here trying to sell that here. And that's totally fine, it will happen. But the idea is more often than not, you're going to land on the right side of the market knowing that 4-hour is bullish. Those are going to be longer trades than your pullbacks. And if you follow expectational order flow, 70 or 80% of the time, your trades are going to align a lot better. They'll work out for you. And I'm not saying you're going to get your win rate up to 70 or 80% of the time. It's just continuations work 70 or 80% of the time. Reversals only work 20% of the time. The chances of you catching this point and this point and this point, they're very slim. Whereas the chances of you letting the market show you that it wants to go up and catching a trade off of it are a lot higher. Again, and don't worry, we won't do the whole chart, but I want to do a few examples so that everybody gets this. So again, you have a form of a supply, it fails. Now, in this case, they do not come back and mitigate this, but you do have more supplies that fail here. You have actually another little bit of a supply that fails here, and we won't know which POI is going to work every time, but in this case you also have another supply zone on this doji. You really don't have the greatest interaction there, but you do have a bit of a reaction point, and you do have a demand zone. Now in this particular case, this is the zone they decided to go off of. And this is why we pair time frames. I don't know if it's going to be this zone or this zone or this zone. Nobody does. But what we can do is pull all of these zones that could be something and wait for price to show us some kind of reaction. The market will usually show you what it wants to do. You sweep the lows, you sweep the highs. What causes it? Something inside this doji demand. And something on the 1 minute is going to tell you that you're going to want to take price higher. So whether you wanted to pay yourself, just little bits right here just to make sure you got paid, or you're more looking to hold for the longer targets, completely up to you. My method is try to take something out of the market every day. You're not going to win every day, but try to pay yourself on every trade at smart points, because we're not guaranteed that this impulse is going to take this high. Yes, we're bullish. Yes, this high is going to go, but we don't know the market's not going to do this. And we always want to be taking profits off the market. But again, expectation is this low is going to stay intact and this high is going to go. And you can see that once a trend is confirmed, expectational order flow plays out in your favor quite a few times. Now here, so this is a bit of a different scenario. Here you have a 4-hour trend change when this low goes. And the way you would play that is you would be open to short and buy ideas because it's not confirmed, but you trade what you see. So if this whole time we have supplies in control, and pretty much this whole time supplies in control. Now on the 15, supply finally loses control here and demand takes over. Now we don't know if it was just going to be to grab this liquidity or if the 4-hour is going to confirm the trend. So once this 4-hour goes and confirms the trend, now we can start formulating the idea that our expectation is that lows are going to keep going until they don't. So now we're going to keep looking for lows to go as price carries on. And we're always looking for that pullback. Now at this point here, when supply gets disrespected, you probably have... So let's see, let's zoom in on this. So supply gets disrespected at this point here, and this is where your change of character happens. You sweep the lows, you sweep the highs. So supply was in control, you're making lower prices. Supply lost control, demand takes control. So where are they likely to mitigate? Most likely where the money exchange hands. Now, at this point, we think we're bearish. So you would probably not be looking to run this high because 4 hours bearish. So our expectation at this point is to make a new low. However, you get in here or anywhere in here, you are still safe to take this trade. Relative equilibrium. You could even go as far as saying this high failed to take this low, so this high is weak. And we'll get into that in one of the next sections, but the idea is you start building a narrative, and the narrative is this high failed to do its job and take this low. We're going to get in here, and I'll probably pay myself here because it's counter trend, but this high is weak, so I'm going to try running it. But at this point, you're probably not going to be trying to run the 4-hour high. Now, once the 4-hour high gets run, you could start being open to buys and sells. In this case, the 4-hour high gets run and price just continues on bullish. and it doesn't even come back. Price is really bullish and blows all these highs out of the water, so it takes all three highs in one go. So what this would have been is a daily pullback to grab liquidity and mitigate a daily order block, and that's totally fine. But now expectational order flow realigned, and now we are looking for the bigger trades to the upside till the trend ends. Once the trend ends, we will be looking for expectational order flow to continue to the downside. And the idea of all this and showing you guys this is allowing you to build a story and a narrative of which way I want to trade and why. As long as we're bullish, we're looking to run these highs. Here we fail to run this high and we run this low. So my expectation now is, even though we're not confirmed yet, I start looking at other clues the market gives me. What other clues is there? Well, for one, let's look at that aggression down, and let's look at the way this low went. Like, it didn't just take that low, like it completely blew it out of the water. A lot of aggression. So now we can start forming the ideas with the amount of aggression we had. Maybe it's going to be a complete change of trend. Now we're still not against buys, as this is not a confirmed trend. This is just the first low. So at this point, you'd still be looking for buys and sells. But the expectation is if the bearish trend is to continue, this high is to stay intact. And this high will not close above this high. It may wick above, but it will not close above it. And as long as that continues, we can keep on building a narrative. Oops. And that narrative is to continue to the downside. So every time, so price is at the extreme, you're gonna probably think that shorting's not a terrible idea. Now once this low goes and this trend is confirmed, every time you're playing a pullback, you know that the pullback is less likely to continue past relative equilibrium. So in this case, if you entered a buy, once we get past the 50% or the relative equilibrium, you're probably not going to want to keep buying. And our expectation is this high is going to stay intact. Something somewhere in here, lower than this point, is going to show us that it wants to continue down. So in this case, we end up taking all the liquidity here and we aggressively again come down. Now price doesn't need to return to the peak. It does not. And believe it or not, this is actually the order block here being respected. And an order block and a supply and a demand is all the same thing. So supply is when we're selling, demand is when we're buying. An order block can be a supply or a demand. But you could see that we've wicked above it several times, but we've never once closed above it, which is showing us that supply is in control. Then you get this really aggressive move down. You can start building a narrative that the next thing that's likely to happen is this low is likely going to go. And basically, you can take this on any time frame, and more often than not, expectation order flow will continue till it doesn't. Like even here, we break expectation order flow and 4 hour becomes bullish by breaking this point. But the trend never even gets confirmed because we instantly take this low. And then here you take the high one more time. So here you become confirmed bearish again. Here you become unconfirmed bullish again, confirmed bearish again. But as you can see, the trend continued on down. And if you look at the market from an order flow perspective, I'm just going to delete all this. If you look at the market from an order flow perspective or any time frame, you can figure out what's likely to happen. And if something reversed, if you can't figure out why it reversed, you just need to look at different time frames. But more often than not, the market will do this or it'll do that on every time frame, And if you could figure out what that directional bias is and create an expectational order flow theory for whatever price action may be doing that week, you can align a story that's going to get you on the right side of the market. I probably rambled on longer than I should have, but the whole point of this is to show you guys that you don't need to be sitting there and trying to find all these reversal points. Every time you're going to try to catch a reversal, I call it catching a falling knife, because you don't actually know where it's going to reverse. So instead, we're going to wait for the market to show us with a change of character, which will be in one of the next sections coming up. But yeah, we're gonna end this video here, and I'll show this in some more action when we get into the putting it all together videos, where we take everything I teach you in this course and we show you how to apply it to a chart, putting it all together and how it all syncs together. But for the time being, I want you to understand market structure and expectational order flow, what you expect the market to do and what you don't expect the market to do. And just by understanding those things, you can be ahead of a lot of the other traders, because market structure is one of the most misunderstood things, and expectational order flow is the next one. And if you can get these two things down, I promise you it'll get you like months and months ahead of a lot of other people. But yeah, we'll cut this video here, and I will see you guys in the next video.